सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो, सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Hello and welcome to this episode of Macrosutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint, and this time we're going to be talking about India's inclusion in the JP Morgan Emerging Markets Index. What this means, what are bonds, how does this benefit the country? Now, when it happened, various government officials, of course, came out and said that it's fantastic news. It shows that India has finally arrived. But that's what government officials are going to say. So we've actually analyzed and seen whether this in fact will benefit India. And if so, how will it benefit us? And that's what we're going to discuss in this episode. And we have with us, like always, Radhika Pandey, Associate Professor at NIPFP. Thank you, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, let's start at the very basic, which is, what is a government bond?
So, government bond is an instrument to borrow money. Like we all borrow money. So, if the government has to borrow money, it issues its bonds for the prospective lenders. Now, it can issue bonds to the banks. It can issue bonds in the market where people like us can go and invest. So, we will park our savings and bond will give us an interest rate, periodic interest rate. And at the time of maturity, the government will pay back the principal. So, it's an instrument for raising funds. It's an instrument for raising funds by the government. And if we look at our bond market, the government bond market is the most dominant bond market.
Right.
You know, outstanding in terms of numbers, if we want to see outstanding government bond market is more than $1 trillion in outstanding value of government bonds.
Right.
So that is the extent and scale of government borrowing, and it all depends on our fiscal deficit. You know, whatever is the fiscal deficit, a large chunk of that is borrowed through the issuance of bonds. Bonds can be short dated, bonds can be long term, and like RBI comes up with something called a half yearly borrowing calendar, where it tells the market that as a debt manager, we are going to issue bonds of the government. Some of them will be treasury bills, which are less than 1 year. Then there will be 2-year bond, 5-year, 20-year. This time around, we've come up with a 50-year bond.
Right.
So that is the instrument, a key instrument for financing the government's borrowing program.
Right. And so basically the connection between the fiscal deficit and the government borrowing is very simple. A fiscal deficit happens when the government spends more than it is earning. And how can it spend more than it's earning? It's by borrowing. So that's where this borrowing program comes in.
Right.
So now, what does it mean that JP Morgan has included India in its emerging market bond index? What is that index and what is our inclusion?
Yeah, so we have these couple of bond indices where different countries' bonds are listed. And there are some bond indices which are particularly for the emerging markets sovereign government bond.
Right.
So JP Morgan is one of them, a highly prominent bond index where different government securities of different emerging markets have a weight. So it's a weighted average of the government securities of different emerging markets. Now, why this is important is that there are a set of investors in the market who will only invest in a government security if it is part of an index. Like we have in India, we have in the equity market, we have Nifty, which is an index of 50 most traded market capitalization.
Right.
Similarly, here it's also an index which has met where those bonds are included which have met certain conditions.
Right.
Maybe they are open to, they do not have capital control, they are open, they have a certain notional value of outstanding issuance, they have a certain maturity period. So based on certain criteria, certain number of bonds of different emerging markets governments are included in an index.
Right.
So when bonds are included in an index, it automatically means that the attractiveness of the bonds to foreign investors will increase. increase, because there are, as I said, there are a set of investors who will not invest in Indian government bond if it is not part of on its own, if it's not part of an index. But if it is part of an index, they will invest, and they will invest in proportion to its weight. And 10% is the maximum weight and India is going to have a 10% weight over a span of 10 months. So that means that it will lead to a higher inflow of foreign funds. It will lead to a more diversified set of our investor base. It can potentially bring down the cost of borrowing and other impacts. But at the same time, because now foreign investors are looking at your market, it means that macro stability will gain prominence, fiscal prudence will gain prominence. All these metrics would be carefully watched out for.
Right. So I was actually going to go through these various impacts one by one. So now, what in just the bond market itself, what do you see the impact as being? One, in terms of the deepening of the bond market, the inflow of more funds?
Yeah. So the most important and significant impact is that the investor base will widen. So if we look at the ownership pattern of government securities, who is holding government bonds as of now, more than 60% is held by banks and insurance companies.
Right.
So, and the share of foreign portfolio investors is less than 2%. It's only 1.6%. So it's mainly held by banks and insurance companies. And why are banks holding? A large part of that is to be explained through the use of statutory liquidity ratio. Right. That means that, RBI mandates that banks have to invest a certain proportion of their deposits in terms of their deposit and time liabilities. They have to invest in government bonds. So and earlier this SLR ratio used to be more than 40% in 80s. So that means that your investor base is highly captive. The RBI can raise the SLR, the statutory liquidity ratio,
and the banks have to
invest. And therefore there is no incentive for fiscal discipline, because whatever is the deficit, which will then translate into borrowing, that will be taken over by banks. Banks will subscribe to this because their regulator has asked them that the X percentage of your deposits you have to invest in government bonds.
Right.
So now this was a problem. This is a case of financial repression. A lot of expert committees then recommended that this SLR needs to be brought down. And yes, indeed, this SLR has been brought down, but even now it is 19%. So even for insurance companies, there are these regulations that you have to invest a certain proportion in AAA rated government bonds. So primarily the investor base is captive in nature, and therefore when we'll have more foreign funds through the inclusion of government bonds in the index, it will lead to more inflow of foreign funds, and the reliance on captive set of investors will go down. So that's the most obvious advantage, that it will lead to diversification. Now, second, as you mentioned, it's about the cost of borrowing because there will be greater demand for government bonds. So that will lead to lowering of cost. Normally what happens is that if you are issuing more bonds and there is not enough demand, because there are just these captive set of investors, we do not have very many diversified set of investors, then you'll have to offer a higher interest rate.
You have to make it attractive.
You have to make it attractive.
We'll give you more interest.
More interest rate. So, but when you have more set of investors, then in that case, the demand is more, then you can issue at a lower cost. And that will have a spillover impact on other financial markets as well, because government bond yield act as a benchmark for corporate bonds
as well.
So companies' cost of borrowing will also come down. So that's the second impact. And third important impact is that because financial repression will likely come down, banks will be in a greater position to lend to other entities as well. They will be able to lend to MSMEs. So that's a very important impact. They will be able to lend more to retail. It's not that their funds would be locked up in investing only in government securities.
So what they call the crowding out effect will be less.
Yeah.
Right.
Yes.
Okay. So now there are two things. One is that if the government bonds, the yield is coming down, that is the interest rate that they're giving out, could be potentially lower,
Right.
will it still be an attractive investment destination for people abroad looking to invest? I mean, if the yield goes down, would it still be
So here, then they will have to look at what is the yield in comparison to the yield in, say, US.
in other countries?
And then they have to compare that with the exchange rate, because who's bearing the exchange rate risk? The investors, because
Right.
it's not that the bonds are being issued in dollar. Bonds are rupee denominated. They
Yes.
are being issued in rupees. So firstly, the interest should be, the yield or the return should be high enough to cover the exchange rate risk that the foreign investor is bearing. Currently, as we know that, the differential between the 10-year Indian bond and 10-year US bond has narrowed considerably because the US bond yields are rising. So in that situation, the advantage will not be too much in terms of return. But as and when this currently the US is facing high inflation, high fiscal deficit, therefore their yields are higher and therefore the yield differential is narrowing. But as things normalize, we will see that the yield differential, if it goes back to the normal, which is around 4%, then it will lead to more inflow of foreign funds, given that Indian bonds get included in the bond index.
Right. So you've actually answered a question that Aditya had posed, where he was asking that even after listing Indian bonds globally, how tempted would foreign investors be to invest in Indian government bonds, considering the fact that their net returns might be offset by the currency fluctuations?
Yeah, so that aspect will always be there, and for that we have to do other reforms as well. That we need to have a well liquid derivatives market, because it's the foreign investor who's bearing the exchange rate risk. So there needs to be a market to hedge the foreign exchange rate risk as well.
Right.
And the other thing definitely is that the interest differential has to be significant for the foreign investor to be attracted towards the Indian market. And as of now, that yield has narrowed, but over time, in fact, by next year or so, by the time this inclusion actually happens, because this will happen not now, it will happen next year.
It's with staggered effect, yes.
It will, staggered effect, but even that will start from June 2024.
Right.
So by that time, we should see this yield differential widening, and therefore the net returns would be positive.
Right. And now JP Morgan has taken this step.
Right.
But do you see other investment banks also following suit, which then would kind of cement these benefits that are coming to India? It'll make it even more.
Yeah, it'll take time, because they would want to watch the experience of JP Morgan and
Right.
then include in their indices, particularly also so because the conditions are more stringent for other index. That is
I
also
see.
an important point. And here currently the two the roadblocks still persist, because why we were not being included in the bond index, there were two problems. One was that they were insisting on settlement in Euroclear market, the external market.
I see.
Whereas Indian government officials were not agreeing to that. And the second is that they wanted tax benefits or exemptions for investors in government bonds. Even that was not agreed to. So these two roadblocks still persist, and we need to see when these actually take shape, how will the investor interest vary accordingly. So once these issues are ironed out, I think then the other firms will also take interest and take steps towards inclusion of government bonds.
Right. And so now we've talked about the impact of the currency fluctuations on whether people will invest. But Sankalp has a kind of a reverse question, which is that will global listing and an increased global demand for Indian government securities impact our foreign exchange, because there'll be more currency from abroad coming in?
Yes. Yeah. So it's a very good question, because here what is going to happen initially is that there will be an inflow of funds, and we know that government bonds are rupee denominated. So there will be more demand for rupees. So that will put an upward pressure on rupee, and rupee will tend to appreciate.
Right.
Now comes the role of the RBI, whether RBI will allow the rupee to appreciate or whether it will intervene in the market. Because if the rupee appreciates, we have a strong exporter lobby who will not want the rupee to appreciate a lot, because that will make our exports
more
uncompetitive.
expensive. Yeah.
So it depends on what will be the RBI's policy response, whether RBI will allow the exchange rate to appreciate, to what extent, and what will be the extent of exchange rate management. Because here, what RBI will do is RBI will absorb dollars and provide rupees into the market. Now, that will have consequences for our monetary policy and liquidity, because it will lead to more inflow of rupees into the market.
Right, of course.
There will be increase in money supply,
which has inflationary
effects, potential.
Yeah.
Then RBI will have to do something to again absorb this liquidity, either through open market operations or through sale of bonds. So all these challenges need to be seen. What will be the extent of activism of the RBI in managing the exchange rate?
Right.
Because we know from our conventional textbook economics that there are three pillars of the impossible trinity. You can manage only two of them. So now when we have an open capital account, and if we are managing the exchange rate, then we cannot have an independent monetary policy.
Yes.
So these things need to be seen, how these policy responses play out. Ideally, RBI should allow some amount of rupee appreciation, but if there is a tendency to intervene in the market at every step of the way, that will confuse the market participants also to what is the RBI stance, whether it wants to have a tight monetary policy or the loose monetary policy.
And on the one hand, the government is allowing one thing, RBI is trying to stop the effects of that other thing.
Yes.
It is confusing.
It is confusing. So it will have a detrimental impact on market and investments.
Right. And now Subhash has quite a basic question, which is, how is this going to impact the layman in India?
So there are various indirect ways through which it will impact the layman. First, as we discussed, that the captive set of investors will be more free to lend to other productive sectors, because a lot of their deposit base, which is currently locked up in government bonds, will be free to lend to other sectors. So because MSME is one sector which is starved of funds, which still depends primarily on the informal segment for borrowing. So it could lead to greater inflow or lending to MSMEs, to the retail sector, to industries, to whoever, to the private sector in general who is in need for funds. That is one. The second is that it will lower the cost of borrowings for the government. And if the cost of borrowing goes down, that means interest payments as a proportion of the overall expenditure will go down.
Will be less.
So there will be more scope for spending on capital expenditure, which will have employment potential,
or developmental
expenditure, social, education, health, and so on. It's not that a large chunk will go into financing interest payments, which will squeeze the expenditures on other segments. And also it will reduce the need for increasing tax rates, which directly impacts us.
Which is fantastic.
So these are all indirect spillover benefits that will flow from the potential, the benefits that will flow from inclusion of bonds into the index.
Right. And now we've touched upon this earlier in our discussion, but Aditya asks that at a time where the market, and especially the Nifty, is touching an all-time high, and where mutual funds are already providing such great returns, how attractive is it even now to invest in government bonds or bank fixed deposits, which are all giving returns in single digits? In the modern world, in modern times, as he puts it, are these investments still relevant?
They are relevant for different strands of people, because there are some people who have less of appetite for investments or for higher risk. So they will not go in for investing in equity markets. So, and currently what we have seen is that the retail investor participation in government bonds has increased recently, because one of the reform that we have seen is that, the government and RBI have liberalized the norms for foreign participation in government bonds. At the same time, there's also easing of norms for retail investors in government bonds. So there is a greater attractiveness also to invest in government bonds. So it's not that everybody is investing only in equity. This depends on the risk-return trade-off of different set of investors. And generally, foreign investors, those who are, who are in the nature of a fund, they will definitely they would like to invest in government bonds. And as we saw that what are the kind of securities who are getting invested, who are now part of this index? They are those who are part of the fully accessible route where there is no restriction. So there are different maturity profiles of these government securities. Some are 5 years, some are 10 years. So it will kind of deepen the market because different investors who have attractiveness for different maturity profiles. Some would like to invest in medium term, some would like to invest in long term. So that will deepen the market and impart more liquidity to the market and reduce the cost of borrowing even for the retail investors. So all in all, it is a good move. Yes, there are challenges that we can talk about, but it is an important move.
Right. And now that you mentioned the challenges, so what are those?
The challenge is that now you will be subject to greater scrutiny because the main point is that now government borrowings will become more and more market determined. Right now, if your 60% is being financed by only banks and insurance companies, potentially this will reduce. Gradually, it will reduce the share of these captive set of investors, and the share of foreign portfolio investors will increase. Even though it will increase only marginally. Right now, it is 1.6% of the outstanding bond issuances. It might increase to 3 to 4%, but still it will impart some discipline. And because you are now part of the index, there will be comparisons amongst the various emerging markets.
Of course.
What is your fiscal trajectory? What is your fiscal discipline? Are you deviating too much from the fiscal deficit target? So all these things will gain more prominence. Sticking to a fiscal consolidation roadmap will gather greater scrutiny. Right now, we don't see that much of scrutiny. As the government goes to the market to borrow, it will lower cost of borrowing, yes, but it will also impose greater test of market discipline because there are more market-oriented players now. So government has to focus on fiscal prudence. Government will have to focus on fiscal transparency. So one of the major reform that is needed is that the FRBM needs to be amended to bring in realize the realities of the current world. So as of now, it's still showing 2021 and the target as fiscal deficit of 3% of GDP.
Yes.
So we need to tell the investors what is the glide path, what is the fiscal consolidation roadmap. We know that fiscal deficit has to be 4.5% by 25-26, but what is the roadmap, and what is the roadmap for debt reduction?
Correct.
Because currently our debt is still 88 to 89% of GDP, the general government debt. So what is the trajectory for reduction of central government debt? What is the trajectory for reduction of general government debt? All these things need to be communicated very clearly to the market, which requires amendment to the FRBM. So
otherwise these people will not invest in the bonds.
They will not invest.
It's as simple as that.
Yeah.
And so now Saurabh had a question which is to do with capital account convertibility.
Right.
So he asks, what exactly are the changes that the RBI needs to do to increase capital account convertibility? And will capital account convertibility put pressure on states and central governments to become more fiscally prudent, as you were just talking about?
Absolutely. So capital account convertibility is happening at a very gradual and modest pace.
First, we should actually maybe tell them what it is.
Capital account convertibility is when we do not have any restrictions on the inflow and outflow of foreign funds in the transactions which are part of the capital account of the balance of payment. So we know that we have current account of the balance of payments, which primarily includes exports, imports, invisible. So rupee is convertible for current account transaction, but rupee, our currency, is not fully convertible for capital account transactions, which mainly include FDI, foreign direct investment, foreign portfolio investment, borrowings, external commercial borrowing. So there are restrictions. So now here the debt market, the investment in debt market is also a part of the capital account of the balance of payments. And what we have typically seen is that even prior to COVID, there were very harsh restrictions on foreign investment in the debt market, in the sense that there were quantitative limits, not just percentage limits. There were quantitative limits on how much foreign investors could invest in government bonds, how much they could invest in corporate bonds. Then what we saw that there was some easing of this limit, and we move from quantitative limit to percentage-based limit,
Right.
which is that currently it is still there, that 6% of the outstanding bond issuances can be invested by foreign investors.
Right.
So that is the change that happened. And then in 2020, when we had this peak of COVID, during that time, a lot of reforms were introduced, and we tend to forget that one of the reform was also reforms in the capital account framework.
Right, correct.
A lot of capital account convertibility measures were taken during that time. One of this is this fully accessible route, where the RBI notified a certain set of government securities where there would be no limit of foreign investments in government securities. So, and exactly these are the securities which are going to be included in the index. It's
And
not
those
that,
are the steps that kind of encouraged even JP Morgan to include it.
Absolutely. So that was the first step which paved the way for inclusion of Indian government bonds in the index, because not all the bonds are index eligible. It's only those that are part of this fully accessible route where there is no restriction on foreign investment. Only those are included.
Right.
So that is the journey till now, and what more needs to be done is that this frequent changes in capital controls or ad hoc changes in capital
That needs to
control,
stop.
that needs to stop. And we have I think learnt our lessons during 2013, during the time of the taper tantrum. RBI came up with a lot of measures to restrict the outflows, because at that time India was one of the countries that was part of the Fragile Five.
Yes.
And when the US just indicated that they are going to taper their bond purchases, it led to an outflow of funds from India, and we were vulnerable to external shocks because of our high fiscal deficit and high current account deficit. And what did we do? We imposed a lot of restrictions which did not work, because they
Right.
were all ad hoc measures. They were all panic driven measures. So those need to be avoided, and slowly and gradually a review of the capital account restrictions need to be seen. We are moving positively in that direction. Only thing is, we should not reverse. If there's some crisis like situation, or there's some vulnerability, and there would be now episodes of vulnerability
Correct.
when we are allowing foreign fund. So the response should not be one of ad hoc, panic driven, and
Yeah.
it should be based on macro fundamentals. So that's the key point from the capital account framework that needs to be done.
Right. So there you go. I mean, overall, it's a good step that India has been included in the JP Morgan Emerging Markets Bond Index. More foreign funds are likely to come flowing into India. It'll become cheaper for the government to borrow. And because of that, it'll also become cheaper for corporates to borrow, which it'll also mean that banks will have more capital to lend to other areas, like not just the government. They'll be able to lend to companies, MSMEs. Basically, anybody who's looking to take a loan has now a greater avenue to take that loan, which is a good thing for growth for us. And in general, it's a good thing in terms of the financial stability of the country. On the other hand, this will expose the government to increased scrutiny from abroad. They're going to look at our fiscal prudence. Are we sticking to our fiscal deficit targets? Do we have a fiscal deficit plan? How are we going about our borrowings? All of that will come under greater scrutiny, which I think also is a great thing. So all in all, it seems like it's a positive move, but the ramifications of it, of course, will unfold, because it's going to even start only next year. So we'll have to see. But on that note, thank you so much for watching.